From 1981 to 2010, one fund manager achieved an annualized return of 30% without recording a single down year. This chart shows exactly what that looks like in practice. A $1 million investment with Warren Buffett in 1981 would grow to roughly $240 million by 2010. Over that exact same timeline, 30% annualized growth turns that million into $2.6 billion. That manager is Stanley Druckenmiller. He hit those numbers while navigating the most destructive global economic disasters of the modern era. He survived the Asian financial crisis. He navigated the dot-com bubble. He traded through the subprime collapse, all without taking a single loss. His success stems from a brutal willingness to walk away. In 2010, the moment he felt his returns slipping, he closed his fund entirely rather than deliver average results to his clients. Yet, just recently, this undefeated investor cleared out his most profitable holdings. He dumped massive positions in Nvidia, Meta, and Palantir. He took that capital and aggressively pivoted, buying into copper mines, 3 major airlines, and international stock markets, which forces us to ask, what does a legendary macro investor see approaching in 2026 that the rest of the market is completely ignoring? To understand his massive shift in strategy, we have to break down his 3-part playbook. Surviving the next market cycle requires dropping familiar habits and looking at the specific mechanics of how top-tier institutional money actually operates. Look at his recent play on Teva Pharmaceuticals. He secured a 97% return in just 6 months. This diagram illustrates his target, the vacuum zone. Value investors sit on one side, and growth investors sit on the other. The empty space in the middle represents a stock totally ignored by both factions. This chart shows Teva's PE ratio expanding rapidly. A PE, or price-to-earnings ratio, measures a company's share price relative to its per-share profits. 6 months ago, Teva sat in the vacuum zone with a ratio of just 6, effectively priced for bankruptcy, while a new CEO executed a quiet corporate turnaround that hadn't yet produced public data. When their next quarterly report dropped with $4.71 billion in revenue, the stock exploded upward. Because no one was paying attention to the company beforehand, there were no trapped sellers waiting to unload shares and drag the price back down. Explosive growth happens when you find solidifying fundamentals in areas completely devoid of market attention. Druckenmiller openly admits he lacks the scientific IQ to analyze complex medical data like gene sequencing. He is not a biotech expert. Instead of mastering the raw data himself, he evaluates the people. If top-tier medical researchers and board members present rock-solid logic, he trusts their expertise and allocates capital based on their conviction. Early in his career, George